In all our earlier illustrations, we are discounting cash flows by using a given discount factor. The discount factor is equal to cost of capital. The actual definition is a bit lengthy. It is equal to risk adjusted weighted average opportunity cost of capital. We introduce discounting as a methodology for adjusting the time differences in cash flows. In addition to time value of money, discounting also considers the risk associated with the cash flows. Firms raise capital from a variety of sources, and we can broadly classify them as a debt and equity. Equity holders bear more risk compared to debt holders. We adjust this risk difference by assigning higher value for cost of equity compared to cost of debt. The purpose for which the capital is raised also affects the risk associated with the capital. For example, a replacement of an existing equipment is less risky compared to risk associated with expansion project. Similarly, risk associated with entirely a new project is more than the expansion project. In computing the cost of debt and cost of equity, the risk associated with the project is also considered. That is, if a steel manufacturing company raises equity and debt to start a retail chain, the cost of debt and cost of equity will reflect the risk associated with the retail chain business. Cost of debt is equal to interest rate. The challenge is computing the cost of equity. We know cost of equity should be greater than cost of debt. For both cost of debt and cost of equity, the reference rate is risk-free rate. Investment in government securities are generally risk-free. Suppose you have 10 million with you. You can invest in government securities and earn an interest yield of 6%. There is no risk in this investment. Asian Paints plans to double the production capacity and approaches you with a 10-year bond issue. You are willing to subscribe the bond if the Asian Paint offers more than 6%. Since corporate bonds are riskier than the risk-free government bonds, you need compensation for taking additional risk. Suppose Asian Paints offer 10% interest rate. You find this is reasonable and invested 4 million. You plan to invest another 4 million in Asian Paint equity shares. What is the minimum return you need to invest in Asian Paint equity? Between bond and Asian Paint equity, you have an option to invest in a portfolio of a security. Investing in a portfolio of securities carries lower risk compared to investing your money in Asian Paints equity. Portfolio theory shows how to measure the risk of the portfolio of a security. We are skipping the theoretical discussion related to measuring the portfolio risk in this course. The risk associated with the equity is assessed through a measure called equity beta. Equity beta is a relative risk measure and benchmarked with the risk of the portfolio of securities. Normally, stock market index like S&P 500 or NSE 50, Nifty are used in the place of portfolio of securities. The beta of a market index is 1. Asian Paint equity beta is derived by comparing the volatility of equity returns of Asian Paints against the volatility of the returns of a market index. If Asian Paint stock returns show more volatility than the Nifty volatility, then the equity beta of Asian Paint is more than 1. We are skipping the computation part of the equity beta. Let us Google it to find out what is the equity beta of Asian Paint. Reuters India shows the equity beta of Asian Paint is 0.94 on March 30th, 2017. What does it mean? It means on average, when a market increases or decreases by 1%, Asian Paint stock prices will increase or decrease by 0.94%. You can search equity beta few other listed companies that you are familiar and check whether they are consistent with your understanding of the risk of investing equity in those companies. Once we measure the equity risk, we can compute the cost of equity. Cost of equity is the minimum return that you would expect to invest your money in Asian Paint stocks. Here is a simple formula for computing the cost of equity. Cost of equity is equal to risk-free return plus equity beta multiplied by the difference between the market return and risk-free return. Here are some practical tips on how to get the values in the above equation. Risk-free return can be identified by visiting the central bank website. In India, you can visit Reserve Bank of India website and find out the current government bond or a treasury bills yield. Equity beta for most listed companies can be found through a Google search. Reuters, Bloomberg, Yahoo Finance are few sources through which we can get equity beta for most companies. Market return less risk-free return is the average historical return posted by the stock market over the risk-free return. It is a long-term average. For the US market, it is around 4%, and for the Indian market, it is around 7%. Suppose yours is a startup and unlisted company. How to measure the equity beta? There is no way for us to measure equity beta of your company directly. The purpose of measuring the equity beta is to assess the risk associated with the equity investment. You can use the equity beta of a similar listed company in the market or average equity beta of few similar companies. Let us complete our computation of the cost of equity of Asian Paint. Cost of equity of Asian Paint is equal to 6%, which is a risk-free return, plus 0.94, which is the equity beta, times 7%, which is the difference between the market return and risk-free return. That gives us 12.58%. The additional 6.58 is the equity risk premium. We have cost of equity and cost of debt. We have already incorporated the risk associated with the debt and the equity instrument while computing the cost of equity and cost of debt. They are now risk-adjusted cost of equity and cost of debt. Suppose Asian Paint has a target debt to total capital of 20% and equity to total capital of 80%. We use these two values as weights for computing the weighted average cost of capital. We need to make one final adjustment. We ignore tax shield on interest expenses while computing the cash inflow. We mentioned that we will consider this while computing the cost of capital. The effective after-tax interest rate is interest rate multiplied by 1 minus tax rate. If corporate tax rate is at 30% and Asian Paint's bonds interest rate is at 10%, the effective interest cost for Asian Paint is 7%. The equation to compute weighted average cost of capital is shown on the screen. Weighted average cost of capital is equal to cost of debt multiplied by 1 minus tax rate multiplied by debt to total capital plus cost of equity multiplied by equity by total capital. For Asian Paints, the weighted average risk-adjusted cost of capital is 11.46. Asian Paints will use 11.46 as a discount rate while evaluating all paint industry related projects. To sum up our discussion, we learned how to estimate cash outflow, cash inflow, principles behind estimating cash flows, cost of capital, and how to use them in evaluating financial viability of the project using one of the three DCF techniques.